Hey everybody, Smart Silver Stacker here. Hope you're doing well. Let me start off today. Say a happy 4th of July, happy Independence Day to everybody watching. Also, I will apologize in advance for the audio quality during this live stream. For reasons beyond my control, it's going to be a little bit funky, but bear with me here because this is important. We have got a major breakout in the chart of silver. As you're looking here, the chart of the silver price, we're in the midst of a major uptrend, right? Kicked off back in February. We've seen silver taken to the highest price levels in over a decade. More recently, we've had a correction, which began in late May. So silver went up above $32 and it's pulled back. It's been a wild ride, lots of oscillation inside of this bull flag channel that silver has been consolidating in. Well, yesterday, on a shortened trading day due to the July 4th holiday, we finally saw silver break out notably above the $30 level, but also it broke out of this bull flag, which from a technical standpoint is very significant. It broke above this downward sloping trend line. You can see silver had touched it once, twice, 3 times, 4 times. Now we blew right through it on decent volume. Would have been nice to see that volume a little higher. I think part of that has to do with the fact that it was a shortened trading day, though. And also, this breakout is confirmed. If you look at the MACD indicator down here, we've got a bullish crossover where the MACD line has crossed over the signal line. So the histogram portion of the chart here has turned green. So of course, technical analysis, short-term price forecast, nothing is guaranteed, nothing is written in stone. But if you ask me, the odds favor a significant rally now in the price of silver to higher highs, right? To maybe the $35, $36 level. You kind of see a similar pattern here. Back in April, you had a consolidation and then a breakout once again to higher highs. That's the leg that took us up to about $32. So if you ask me, this is a good entry point for the silver market, and it's not just the technicals which lead me to believe this. There are fundamental reasons in the economy and in the global geopolitical realm which I think support the forecast that silver is about to run, along with other safe haven assets like gold, to new higher prices. If you want to get your hands on some physical metal, make sure you check out today's video sponsor, sdbullion.com. Right now, at some great Independence Day sales, you can get junk silver coins 76 cents over spot, any quantity. They've got gold 20-gram bars for $27.76 over spot, so great deals there. Good opportunity to load up on some hard assets before this whole thing starts to really fall apart, because it looks like that is where we are headed. These are some of the catalysts for the price move that we had yesterday in silver. First, the ISM showed that the service sector is contracting in a significant way. An ISM index of service businesses sank to 48.8%. That is the lowest level since the COVID pandemic, dropped from 53.8 the month before. So that's a significant drop, and it's a very low number. It's a sign that the U.S. economy, which I think we all know isn't the greatest economy in the world, as we are repeatedly told by the political elites and the central bankers running the show, well, you can only ignore reality for so long, right? And the cracks are really starting to show here. Similarly, in elevated jobless claims numbers. So they rose to $238,000. New data released yesterday. That was against expectations of $233,000, and it is near a one-year high. So the employment market, despite the fact that, all these numbers are massaged, they're designed to, portray this economy in the best light possible. Well, again, the cracks are starting to show here. And the reason this is significant for the price of gold, silver, and markets across the board is because regardless of how high inflation remains, and it is persistently high. We've got this sticky inflation. I think we all know that. Anybody who goes shopping realizes this. The cost of doing 4th of July barbecue through the roof this year. Well, regardless of how high that remains, the Fed is going to have to get in here and cut interest rates, stimulate this economy, because if they don't, well, things are going to start to fall apart. And one thing that the Fed wants to avoid more than elevated inflation is a cascading economic collapse. And that's the reason that, they began to intervene last year when we saw the banks begin to fail. We're only, potentially days, weeks, months, maybe years, if you're very optimistic, away from further problems in the banking sector. A number of areas of the U.S. economy are beginning to contract, and the employment market is just another one of these examples. So it's very likely that regardless of what we hear from the Fed about remaining, steadfast in their inflation fight, that's not going to be the case, right? They are going to cut when they have to cut. Also, this is another chart I'd like to take a look at. This is a chart of the Japanese yen, which has fallen to the lowest level since the 1980s against the US dollar. The yen has been absolutely plummeting. And this could be a real problem for the US dollar because the Japanese now may have to intervene to boost their currency. It's a 38-year low of the yen against the dollar. And how can the Japanese intervene to boost their currency? Well, look at this chart. This is the major foreign holders of Treasury securities provided from the Treasury. And right there at the top of the list, Japan. The most recent data from April of this year, they hold $1.15 trillion of U.S. Treasury securities. One way they can boost the yen is by selling their treasuries, unloading their dollar holdings, and buying their currency in a bid to support it against the US dollar. Now, this is a real problem because we've got already, other major holders of US treasuries like China, for example, selling their treasury holdings at the fastest pace on record. Q1 of this year was a record dump. You can see that in April of 2023, China was holding $868.9 billion worth of U.S. treasuries, now down to 770. So that's a pretty fast pace, and that could accelerate as well. And when you combine China and Hong Kong, their holdings, which they also control, they have about $1 trillion of U.S. treasuries as well. The Fed is still engaged in quantitative tightening. They're selling U.S. treasuries. So who does that leave to buy U.S. treasuries? If you've got the major foreign holders dumping them, and Japan may join that bandwagon soon in a bid to support their own currency, well, that leaves, you and me and retail investors to buy up U.S. treasuries. But if that's the case, we're going to demand higher interest rates. So higher interest rates on U.S. treasuries is a real problem when you consider that the federal government, the Treasury, is already paying over $1 trillion in interest annually. They can't see rates rise much higher than this. That could kick off a vicious cycle of rising interest cost on the debt. Janet Yellen, of course, has told us we don't really need to worry about the U.S. debt. We need to worry about the cost of servicing it. Well, if foreign holders of treasuries start unloading their holdings, that's going to drive rates through the roof, and the cost of servicing the U.S. national debt, it's going to explode. How can the Fed intervene to fix that? Well, they can buy up a lot of debt, monetize it. But obviously, that is incredibly inflationary, return to QE, and it's possible that they could do that. That's going to drive the price of safe haven assets, precious metals, anything that is physical and tangible that you can hold in your hand. Is going to drive it sky high. Inflation is going to be a real problem when that happens. And the Japanese witnessing a collapse in the purchasing power of their economy brings us one step closer to that. The geopolitical arena as well, it's frightening stuff, but we're going to dig into the most recent developments in the Middle East. We just saw Israel launch an airstrike, killing the most senior Hezbollah commander thus far in this conflict. Killed one of their top commanders in South Lebanon on Wednesday, and then that triggered a retaliatory rocket strike by Hezbollah into Israel. Of course, this all is, leading us towards what now appears to be an inevitable escalation in the region, a broader regional war in the Middle East. It's very possible Iran could be drawn into that. Their allies, Russia and China. You can see how this is headed. The Iranians, one of the new members of the BRICS nations, right? And it's very possible that they could be drawn into open conflict with Israel. Both sides, very, very bellicose talking points. Iran recently warning of an obliterating war with Israel. This is very important for many reasons. The first of all, if Israel gets into a conflict with Hezbollah and by proxy Iran, or perhaps directly with Iran, you know who's going to be footing the bill for at least the Israeli side of the conflict. And, we don't have a lot of money to spare for that. We already have a crushing debt problem, skyrocketing deficits. We're already funding a proxy war in Eastern Europe. Now we're going to potentially be drawn into backing our allies in the Middle East to the tune of billions or trillions of dollars. It's going to be very highly inflationary. But more importantly is the fact that Iran is very likely to blockade the Straits of Hormuz. We could very well see an increase in crude oil prices and inflation as a result of that. Crude oil, I don't think, is pricing this in yet. It has been on the rise. You can see year to date it's up 17%, but I don't think that's pricing in a broad regional war in the Middle East. And so this is something that we should certainly be aware of and concerned about. And again, I've mentioned it before, but I think it's worth repeating, is that we saw back in April, there was that potential breakout of a conflict between Iran and Israel. Occurred on a Saturday night. A lot of drones and missiles were fired. It was sort of just a warning, I think, maybe Iran exhausting some of its outdated arsenal, but it was a lot of weaponry that was fired, and it turned out to not be the big escalation that everybody was concerned about. But on that Saturday night, saw a huge spike up in the PAX-G cryptocurrency. That's a gold-backed crypto, PAX-G. And gold markets, they're closed on Saturday nights, so it always seems like these events occur over the weekend. Gold didn't have a chance to respond, but you did see a huge surge up in a gold derivative, that PAX Gold crypto, which does trade 24 hours a day. So I think that gave us a preview of what we may be likely to see in the event of a broad regional conflict breaking out in the Middle East, which unfortunately we do seem to be on the verge of. So look, I think that this breakout in silver is just the beginning. Again, short-term forecasting, look, nothing's written in stone. It's all just about what, the odds of something occurring are. But it seems to me that silver is looking ripe for a run up much higher, both from a technical and a fundamental standpoint. So I'm going to keep doing, what we do. We keep stacking because, if things do play out this way, a global economic crisis, a regional war in the Middle East, then safe haven assets, well, they're just getting started, right? And this is going to look like small potatoes compared to what is coming for what I view as the most undervalued assets in the world, physical gold and silver bullion. So anyway, leave me a comment down below to let me know what you think. Thanks for watching, everybody. I hope you have a wonderful Independence Day, 4th of July holiday. Go out there and enjoy independence from the British, I guess, and stay safe and happy stacking, everybody. Leave me a comment down below. I'll catch you next time. Smart Silver Stacker out.